How's it going, young investors? Today, I'm going to be talking about how to choose the correct strike price when buying an option contract. The difference in strike price can determine how much you can gain from a movement in a stock. So let's get started. I see a lot of young investors make the mistake of investing in options on a stock that doesn't have much volume. When it comes to buying, the speed of when your contract gets received and accepted is dependent on how much volume there is within the option contract that you're buying. So the very first thing you need to do is make sure you're trading stocks that have a lot of volume. You always want to get time in your options call, and then from there, this is where a lot of people get confused. See, 450, 451, 452, these are known as the strike price, also known as the name of the contract. If I'm going to buy a contract and I want you to know what contract I'm buying, I'm going to say the strike price, which is basically the name of the contract. Now, the difference between each contract, besides the premium, is the delta. And the delta is how much you will gain per dollar that the stock goes up. So every contract has a different delta. For calls specifically, the contracts below the share price are known as in-the-money contracts, and they will typically have a higher delta. First contract right above the share price is known as at the money. Any contract above that is known as out of the money. Now, out of the money contracts are cheaper, but they have a lower delta. This is 47. If we look at a at the money contract, you'll notice that at the money contracts have a 53 delta, which is $53 per every dollar that goes up. And what's 53 cents times 100? And if we look at in the money, it's significantly higher. It's 59. And the more in the money contracts you get, the higher the delta gets, and the more out of the money you get, the smaller the delta is, but the cheaper the contract. Now, if you get a cheap out of the money contract, as you can see, the delta here is 19. But the thing is, you could buy multiple of these and that delta will double, right? So there are multiple strategies you could approach, and it really depends on your risk management. And I know you hear this a lot, but it's very important. And as you can see, this contract has a volume of 3,406, meaning it's good. It's going to have a very good chance of you being able to buy and sell. I've had so many new traders come to me and say, when I try to sell my option contract, it just doesn't sell because there is no volume. So that is crucial in choosing your strike price. Make sure that the strike price that you're going to choose has high volume. Another thing you have to keep an eye on is the IV. As you can see, this contract has a low IV. 12% is low. 100, even 300 is high. An increase in IV can cause the premium of the option contract to go up, which means potential gains in play. And as well, if the IV goes down, it could cause the premium to go down and cause you to lose money. So be very mindful about that. When it comes to earnings, a stock option contract will typically go up in IV before the earnings happens, and then when the earnings happens, even if a stock does really well for earnings, the IV gets crushed, resulting in the options contract premium to drop drastically. So be careful with that. So when buying a contract, when choosing a strike price, make sure that the strike price of the contract that you buy has good volume, has a low IV, and check the delta. Now, there are other Greeks that you should know of when choosing a strike price, such as theta, vega, and rho. So the gamma is actually how much change in delta will happen depending on how much dollar the stock goes up. So think of it as this way. Gamma is basically the sensitivity of how much the delta will be moved by. The higher the gamma, the higher the change in delta per dollar going up. The theta, if you notice, the theta is the only Greek that's negative, because that is how much money you're going to lose per day that passes. For Vega, it's a measurement of the option sensitivity to the change in IV. Okay, so it shows how the options price will be affected by changes in the market's expectations of the future price. Now, last but not least, Rho in option trading is a measure of an option sensitivity to changes in interest rates. It indicates the expected change in the options price for a 1% increase in the risk-free interest rates. Take this as you will, but my recommendation to you when choosing a strike price, always get time and always try to buy close to in the money. The further out of the money you get to, the more likely you are to lose money. Now, if you are a professional trader and you know how to use technical analysis to predict price movements, and you have a lot of experience in the market, you can maybe get away with buying out of the money contracts. But as a new investor who is new to options and wants to get their foot in the door, I recommend you get experience buying in the money contracts with time. Ladies and gentlemen, if you enjoyed this video, please leave a like so more people can see it. Subscribe to this channel. This channel is devoted to helping young investors profit from the current market. I know it can be very difficult to learn and very overwhelming. And in this channel, I provide free education for all of you to learn. Join my Discord server. If you have any questions, comment down below. Thank you all for watching. Check out my other videos where I talk about how to day trade options, option strategies, how to day trade in general, how to trade expensive stocks for cheap. I have everything in this channel, and I upload it every single Sunday or Saturday. Thank you all for watching. Peace.